Nice to have you here. I'm Tim Quast, and it is June 5th already. And it's like that here in Denver. With me is Brian Wilson. He's going to go first. We've got where it's not unusual is we've got kind of normal weather in Denver. I was coming back from the airport yesterday and got hammered by rain and hail, which is what you get on the on the Front Range under normal circumstances here in Colorado. So that's normal. That's to be expected. But I was in, we Brian and I that have been in members of NERI, the Professional Association for the Investor Relations Function. That's the liaison between public companies and Wall Street, and we're a data analytics supplier to that constituency. I've been an investor relations officer. It was 20 years ago, but I was out there. I did a panel on the effects of passive money in the equity market. I had the You guys know do you know what the DTCC is? It is the Depository Trust and Clearing Corp. And they clear and settle basically all transactions, equity and fixed income, wherever it can settle. So derivatives, less so, but anything that can settle, they're going to clear that. And the guy who runs the data products group there is a good friend of mine, and I talked him into doing the panel. So it was great fun, and great fun to see a bunch of my friends out there. Beautiful, beautiful weather out in Boston. Okay, I think I've let it. I've killed some time, Brian. So I'm going to hand this off to you for part one, and I will take part two.
Sounds great, Tim. Thank you very much. I appreciate it. Great to see everyone. Hope you're doing well here in early June. As Tim mentioned, it's kind of strange weather. I live in Colorado Springs, about 50 miles south of Denver. I came back. I was away last week, and I wanted to get to the lawn and mow the lawn, and I haven't been able to. It's been so wet, and I think when I get out there, the lawnmower is probably going to stall. So it's that type of weather right now. We'll get to it eventually. Let me go ahead and share my screen. A few topics to discuss. I'm going to start off with I'll call it risk management, and it's a good topic in terms of what can we do to mitigate downside and make sure we're getting the upside that we desire. And I'll give you an example from one of my trades that I made a couple of days ago. Now I made money on this trade, but I made it difficult on myself. So I entered into this trade OKLO Tuesday towards the close. And part of the reason that I made it difficult on myself, look at the intraday volatility. It's just a huge number right now. Now, what I did is I gave myself 2% to the upside. I took half my position. I made that 2%. But as soon as I made that 2% within like the first minute of the trading day, this guy went down about 6% in basically the blink of an eye. And it was a good reminder for me. When there's a lot of volatility in a given stock, well, there's going to be volatility both to the upside and potentially to the downside as well. Now, I had already made money on half my trade, so I wasn't necessarily concerned about it, but it's just a good reminder. And let's talk through for a moment. Let's say that you enter into a trade. Dutch Brothers. I know it's up and away today. Probably not a good time to place that trade. But let's say that it was a little bit different. You entered into it at the end of today's trading day. You're watching it tomorrow. What could you expect there? What's the dynamic? Well, potentially the potential downside, normal trading of around 4%. What I've been doing recently in terms of stop losses is I've just been using a mental stop loss. And what I mean by that is, let's say Dutch Brothers, 4% volatility. If I'm comfortable with that potentially moving down 4%, I'll just kind of let it go. The reason that I'm doing that, not putting a stop loss out in the market, is because sometimes the market makers will game those stop losses. So let's say that I set it down 4%, the stock goes down 4%, my stop loss gets hit, and Dutch Bros goes right back up again. So sometimes that dynamic will work out where the market makers will game those. So if you have time to just kind of to watch some of your names, and by watch them, I don't mean watching them every minute. I'm looking at my watch list maybe every 20 to 30 minutes, something like that, just to give you an idea. If you don't have time to watch them, then please set a stop loss so you don't get burned. If Dutch Bros goes down 4% one day, it could go down 4% the next day, and suddenly you're sitting on a 10% loss. So just a thought about risk management. One way that I'll approach it, for the most part, I'm going to try to avoid some of these names. The one and what I mean by is the ones that just have extreme volatility. That's just hard to stomach for me. Maybe some of you can stomach your names going down 5 or 6%. I'd rather not be sitting on that type of loss. So I'll try to play more of these names that have lower volatility. I was talking to one of our participants yesterday. That was actually one of the topics, was risk management. But also we got into the discussion of, one way that you could set up a longer term portfolio. And let me show you what this looks like. And Tim has a longer term portfolio that he's been testing, but this is just a really simple way that you could do something like this. Let's say that you have $20,000 that you want to invest over time. It's more of a longer term portfolio. And you can use edge both ways. You can use it short term, you can use it longer term as well. Well, let's say that you have that longer term portfolio, and you're just keeping it simple. You're just going to plow money into SPY. When would you want to do that? Well, you would want to do it when the market moves, when sentiment moves below green. And in this simple example, let's say every time it moves below green, you put $2,500, into that SPY holding. And during the course of a year, you're probably going to get 2 or 3 opportunities at that. If it's a longer term holding, you're buying at the most opportune times, and then hopefully over time, that position is growing. But that's just one way that you can think about it. In general terms, especially for those who are new to Market Structure Edge, green means go, red means stop. It's kind of just a simple way that you can think about trading. So with that being said, we're actually going to talk about this red here for a moment. This last stretch, really over the last month or so, has just been an extreme outlier, and I'll show you what has been happening. I do have a spreadsheet because I like such things. And trust me, I won't take you through all these details, but what this spreadsheet captures is when sentiment moves above the red line. And let me get this. So right in here. So when sentiment moves above the red line, when it comes back through the red line again, and in general terms, that movement above the red line, it usually looks something like this, where we're above those stretched or overbought conditions for about 9 trading days. The market returns during that period, usually 40 to 50 basis points. So in other words, the market's been moving higher, market gets stretched, everything kind of comes to a screeching halt for a period of time, and then we see what happens after that. Look at this stretch that we had right here. Once again, just an extreme outlier. Let me show you what that looked like. We were above the red line for 24 days. The average is 9 days. There's the average return. Actually, this was 40 basis points just a couple of weeks ago. So this stretched picked that up by 20 basis points. And let me show you what it looks like when we just look at the outliers in the data. There's what we were just looking at. 12% return when we were above the red line, just an extreme outlier. The only time that we've tracked anything similar to that, we were coming out of the pandemic. So we had 15% returns. We were above the red line 17 days. You can see the only other time we've really been that many days above the red line, that was later during pandemic trading during November of that year. So you've heard us use the term outlier many times recently. There's a reason for that. This stretch that we've been going through here during the last few weeks, just an extreme outlier, any way that you want to look at it. A couple more things to show you here before I turn it back over to Tim. This stretch is what we call a double top. And what that means is that sentiment was positive, it stopped, and then it moved higher again. And this one was almost a triple top. It's only happened a few times in our data set. And as I'm looking at the data, more and more this resembles 2020 trading. And I don't know what to say to that other than to just share share with you that that's what I'm seeing in the data right now. So if we look, this was 2020. That was the sentiment top at that point in time. And notice the extreme movement in short volume as that moved higher, and that stayed elevated. That was about a 3 month stretch that it stayed above those levels. If we look at where we're at right now, once again, there's that sentiment top, extreme outlier, and we're seeing that same type of outlier from a short volume perspective. That stretch right in there, that's the highest short volume that we've ever measured. In one way we were describing that as the SPY moved higher, this was almost a meme stock effect for the whole market. So in other words, there was so much demand in the market that there was extreme borrowing of shares to facilitate that demand. Short volume shoots higher, and you get these outliers from a market perspective. One more item to share with you here. This is on the SPY. This is 2020 once again from an SPY perspective. SPY gets fully washed out from a sentiment perspective down at 1. As it rallies, it never sees 1 again, and you can see, we're regularly hitting 10s during that stretch. Here's where we are right now. What are we in the middle of? I mean, who knows? It's really hard to tell when you're in the middle of something. But if you look at sentiment getting washed out, it happened twice before we started to catch this rally. And we've had a good stretch here where SPY sentiment has been bumping up against 10 quite a few times. Where do we go from here? Well, we'll touch that in the what's ahead segment. But we are in the middle of outliers for now. Whether it makes any sense or not, there are a lot of comparisons to 2020 data. And for now, I'll leave it at that and turn it back over to you, Tim.
All right. Thank you very much, Brian.
Uh-huh.
Let's see. I've got 3 things that I want to share, which should leave us plenty of time for the what's next segment. And to me, the big thing is, I'm just sharing my screen here, and I can't do 80% of one thing at a time. So let me do that part. There we go. Okay. Obviously the thing that we think about all the time is, what one could construe as a disconnect between demand and supply and the performance of price. And this is a long range look. And since I'm here, I'll start with this, but hold that thought. The current disconnect between demand and supply and how prices performed. And then does that mean the data is wrong? Well, I'll explain it in just a moment. But I'm going to take the third item first. I have said that I don't think that the regime, when I say regime, it is the central tendency in the market, has changed since this volatility started. And here's what I mean by that. So This period, we're looking at the entire data set back to this is when we, after 18 months of testing of some data, could say, all right, we have validated these data and they have merit and we can track them market wide for the what's called the national market system. And that's why it dates to July 3rd. It's because that's where the data became available. We couldn't control that. It was controlled by the stock exchanges principally. They sell data. And so, you could look at various, to me, regimes. Generally speaking, um, there's a regime from here to here. It's kind of similar with periods of insufficient supply and excess supply, but it's generally the same behavior. Then we have this great disruption, as Brian pointed out, with the pandemic. Very unusual circumstance. And in that sense, this too has been a very unusual circumstance, not because of some infusion of money globally. Jamie Dimon pointed out that uh, effectively the world and we added $16 trillion, 8 trillion and 8 trillion to the global money supply during that period of time. And it has a propensity to find its way into risk assets, which inflate. And that means equities, fixed income, real estate, art, pick your thing. And at some point, the regime runs out of steam. And so that regime to me lasted until here. Then you can see a whole change in the regime during this period. And basically, that regime extended until the Fed changed its posture on rates and stopped hiking rates. And so then we have this shorter regime, and now we're in this pattern. Now I don't know. It's not a long pattern. Don't know. Maybe it's an outlier. But whatever the case is, whether it's a short-term event or a longer-term event, what occurred that brought the market down and back up has not changed structurally. That's what you can see in the data. But again, we'll see how things unfold. As Brian said, when you're in the middle of something, it's very difficult to know what's going to happen next. And I think it's a lesson on, how much can you rely on trailing data to tell you what to do? You can only rely on demand supply imbalances, which will always be informative and helpful. But it leads to the next thing. So I'm going to zoom in now and look at a much shorter period of time. Let's take 6 months. And we return to these things because it's internally what we talk about all the time. That this period of time, this where you have the very strong demand top and falling demand and supply that has remained very durable, very high, very close to records throughout this period of time, and yet prices rise. So you would say, well, how could that be true? Because what demand tells us are all the purposes behind price and volume, and whether those purposes are combining prices. And if there's a very long period, it can carry for quite a while. It's like trumping your throttle and getting to 100 miles an hour. If you do that in your car and you take your foot off the throttle, it will still run for a while. Right? There's a significant inertia effect, and the market is very similar. I mean, it's still just manifestations of human behavior. So is it then that surprising that there's been a disconnect? No. But would I have thought we might get more of a bump? Well, yeah, because I've got positions like that. I'm long and short. Because I think when you have an extended period like that, it's, that when you have wild outliers, there are probably opportunities. This was a wild outlier that permitted us to lever long very successfully. This is a wild outlier that to me says we could suddenly drop. And I continue to believe that. And you'd say, well, what point do you throw in the towel? If there is some meaningful change to the data that leads me to conclude there is no longer a probability, then I'll change my posture. I just don't see that yet. And I want to show you a couple of other things here. So this is also that entire data set. And this is taking the call it the average price of the S&P 500, taking all the stocks, generally 500 components, right now 504. The rebalance for the quarter will be announced tomorrow and take place on, I want to say, I don't know, not next week, but the week following. And looking at volatility. And so if you look at the other periods where we had significant volatility events, here's the pandemic, here's 2022, and you look at this period, the fact that it vanished is unusual. And so it either is an extreme outlier and things just carry on, or that's not done. I don't know which it is, but I can tell you every other time in the data set, it doesn't have one event, it has more than that. I don't know. So, but when you want to know why I do the things that I do and say the things that I do, it's because I look at that data. And I want to show you something else too. Let's see here. This may be, bear with me. Here it is. Okay. So if we were to take the same view of the S&P 500, so this is the underlying equities, not SPY, and look at each of the periods where there is volatility and the relationship between buying, closing above the intraday midpoint, and selling, closing below it, they always have historically equalized. And it sort of stands to reason. That was years ago, I was on CNBC with Brian Sullivan, and I said, there will come a point, and I don't know when it is, where the invasion of the market by ETFs and derivatives will reach a tipping point where the underlying buying and selling will not be reliable indicators of what the market will do. I don't know what the consequences of that will be because we haven't been through it, nor do I know when it will arrive. We will know it has arrived when it arrives. So here's the interesting thing to me. We had this giant spike. You can barely see it on your screen, but just trust me here. This spike of what we could call closing above the midpoint price indicating buying was an extremely strong but very thin event. And that occurred in April. I mean, you compare it to any other period, and it's a bizarre pattern. And on the offsetting selling side, there's not even half enough to explain why that occurred. And I look at that and say, once again, well, either there's a lot more to this pattern that's coming, or it is wholly driven by derivatives, because it's the only explanation. If you go back to I've used it over and over and over, the Sherlock Holmes adage that once you eliminate the impossible, then what remains, no matter how improbable, is your answer. And I would look at that and say there was no meaningful buying or selling to support a dramatic move in the market. Ergo, it was derivatives, which means, and what I mean by that is you can substitute things. So options are a right but not an obligation, but it can become a very meaningful part of a portfolio. It's how firms like Susquehanna become top 25 holders of U.S. equities. They're the largest market maker in options. Jane Street, largest market maker in ETFs. Those are put call positions. And yet they have, at any given time, $500 billion of them. So I look at that and say, I think there's another shoe. I think something could destabilize the derivative side. And what happens? That if this pattern holds, there will be a much even larger pattern. Again, I don't know. If at a certain point, demand and supply equalize, then I'll throw in the towel on it. But I think that that's the case. It's why I continue to look at this and say the data would tell us that there is a condition, the consequences of which haven't yet arrived. And maybe they never do. But that, again, they usually do. When you have separation between demand and supply for an extended period of time because there was precedent, very strong demand, it can be very consequential in the aftermath. And I would say those conditions are there now. So how you would use this as a trader, just be very careful. I would not overcommit to this market because I don't believe that everything has returned to normal and everything's okay. I just think you should be aware that that to me continues to present risk. So that's where I've arrived. Now we can turn our attention to what comes next. Questions, comments, observations too.
Tim, there was one question from Joe just about whether if demand goes below the green line, would that change your thinking?
Well, it'd certainly be an entry point. Yeah, it would. It would change
Mhm.
my view. Yeah. And I don't think we're going to get an entry point here. Now, I don't know where it comes. If demand settles at 4.5, that is a bottom. It's not an entry point. And to distinguish between the two, mathematically, when demand drops below 4, the market always rises. It may only be for a day or two, but it always does. When it bottoms at 4.5, it is not necessarily an indication that the market is going to move higher. So, but you're right. Would that change my view? Yes, it would. There was another little thing in here, and I don't know if I have it in front of me. It might have been on another machine. So this is looking at intraday volatility. This is actually in SPY. And when I said volatility, this was an all-time if you took all of the data, this volatility event that occurred here is an all-time record. And it was, instantaneous. So could it return?
Can
Well,
can
it
you can you
always
share your
does.
screen
Oh,
again twice?
sorry. Thanks for the reminder. Yeah. So Joe, yeah, I mean that it would cause me to I would necessarily have to reconsider if we have an entry point. I was talking about this right here. If you take this
Mhm.
is SPY now, not the S&P 500. You can tell by the price graph. So the average price in the S&P 500, if you aggregated all 500 stocks and took an average price, and it's in the 215, 220 range, something like that, I believe. Whereas SPY is, it's close to 6,000, 600, tenth of the S&P 500. So this has had no consequence. Will it? I don't know. It's just those are things we think about all the time. Volatility matters, and to me, there are logical explanations for why the market hasn't done what it's done. What one might say it should have done. On the other hand, should it have done anything other than what it did? I don't know. You have a very long top. Shouldn't it do this? Yeah. And then it might do that. I'm not saying it's gonna, but because there has been no change in this, I mean, if this thing had fallen off the cliff, I'd say forget it. You can, the regime has changed, but it hasn't. And in fact, if anything, it started to rise again, right, Brian? I mean, it's not a pattern yet. It's a day over day change. So, we don't look at it as a pattern change unless it's 3 or more. All right.
Tim, there was
What?
one question from Michael about being in both SPXL and SPXU at the same time,
Yep.
and one from Bill. It wasn't a question, but he's having difficulty with his chart. Wondering if you've seen something similar and if you know how to fix that.
I would dump the cash. So you can always do this if you have issues. We have systems that do this, but you could go here to manage your account and scroll down and clear your local cache. I mean, it's the same thing as clearing out your browser history, but that's an easy way to do it. And we can try flush. I'm sure it's browser related. Our app resides in a browser and it's intended to remain current. If you have browser extensions, it can throw that off, but it's always a caching issue. What was the other thing?
Uh, if you place, this is from Michael,
Ah,
if you're going into SPXL and SPXU at the same time, how do you make money on such a trade? And, what do you do when you're in that type of trade?
yeah. So if I'm in that trade, I'm going to bias it based on broad market sentiment. So if let's say here, right right at month at the conclusion of monthly options expirations, demand is well over the red line and supply is rising. I'm going to bias my trade short, right? And now, if I get the full movement of the market's volatility in a couple of days, then I'll adjust the trade. But that's how you do it. So you would take your profits on the short side and adjust it back to level to me. Um, and you said, well, that's so how you make money on a long short trade is purely timing. When do you let one side or the other go? And clearly here, if supply was falling, you would absolutely shift to a long bias, meaning you would own more SPXL than SPXU. This to me doesn't give me that signal yet, particularly because the market hasn't reacted. If demand is all the way down here and supply has not budged and price is here, what is the probability that at least once, if not more, we could get the full movement down of volatility? By which I mean, how much does the S&P 500 move? 2%, right? Could you get a 2% down move? And if it's if it's a leveraged instrument, it's different than that. But that's what I think about all the time. If can you take your profit long or short, and then you can reset at the end of the day in the last 10 minutes. And that's how you do it, because there's realized and unrealized returns. You could have unrealized losses and realized returns, and then the next day your unrealized loss becomes a realized return. And that's what you do. It's what long short hedge funds do. That's what they're doing. There are known movements of price, and somehow you have to know we're using quantitative data to know demand supply imbalances. And that we haven't seen the effect of this demand supply imbalance doesn't mean that it's not going to happen. It means it hasn't happened yet. It might never happen. That's a small probability. It is a probability. It's just a small one. So that's how I do it. And I do that all the time, particularly during these unusual circumstances. Ordinary circumstances, I only do it at tops and bottoms. Otherwise, trade the daily trading ideas will, where I continue to, at some point we will post these. And I've just got all kinds of things going on behind the scenes that are why we haven't put out like for instance, our buy fives low volatility portfolio. It's up 15% this year. I mean, it's performed very well, might be starting to change. But I'd like to publish those things. I'm just in the middle of other things that sort of prevent it at the moment. All right, talking about what's coming next. What I like to do is, Brian, and you jump in wherever you want. I love to scroll the dashboard and just look at where all the demand supply balances are. I mean, clearly, taking the mega caps, 65, 70% of market cap, demand is no longer falling. Supply has risen from May expirations to 50%. Same condition as the broad market. What does that mean? Is this a market that could rise? Well, yeah, it is. But it's also one where a consequence of this could arise. We don't know, right? We just don't know. And you could look across other major segments of the market. Look at the sectors. What are the sectors doing? Long uptrend in supply, demand bottoming and ticking up a little. But again, those two things offset each other. Huge covering here, now very short in consumer discretionary. It dipped just below 5 and is rising. Does that signal upside? It's not the upside I would take. That I want divergences, rising demand, falling supply. That produces big gains, right? These conditions don't mathematically give you confidence that there are big gains. Take the Dow Jones. You can do it. I just did this manually. Where are the Dow Jones Industrials? They give us no indication of direction here. Supply is right at 50%. Demand's right at 5. Could it rise? Well, yeah, it could. But what if we have a dramatic reaction to the jobs data tomorrow? I don't know. We don't know. I've long expected it. We had an ADP jobs number that was much lighter than expected, 37,000. Now, to me, that's a payroll number. All they're doing is printing payrolls. The government's data, those are surveys. So people downplay ADP and say, well, we pay attention to the government data. Government data is qualitative. ADP data is quantitative. It doesn't tell you how many jobs were lost. All it says is there were 37,000 people added to payrolls in the last month. Well, how many were removed? We don't know. It's like seeing in a double entry ledger system only credits, not debits, so we don't know. But something to keep in mind. You look at big financials. They certainly came. This was convergent. I don't know if we've had that effect. I'm not trading those, but I'd look at that and say, well, demand's rising again, but supply is way up here, right? 50, it's the same as the market. I don't look at that and go, well, that gives me the warm fuzzies. This is what I mean. You look all the data, and it will be one thing or the other. Is price right, or is the underlying data that creates price and volume right? Well, I always come back to the data, my view. Okay, Brian, your comments.
Yeah, thank you. Juan Sebastian had a question about correlation between the market and big tech. How is it that the graphs don't show a much stronger correlation? And I can share my screen for part
Okay.
of that answer. And if we let me get to the right one, sorry. So if we look at broad market sentiment, so this is a measurement of course, the S&P 500. What we're looking at here, this is an average 5-day number. So that's part of the explanation. And Tim, if there's more to it that you want to speak into, feel free to. But when we're looking at this sentiment itself, recognize that it's a 5-day average. We don't want to throw you off too much with, if we move higher one day and then we immediately, move back lower the next. So we want to smooth that out just a little bit. If you look at big tech itself, that measurement is on a daily basis. So that is part of the explanation. You're looking at a daily move here versus a smoothed out move, for that S&P 500 look. And is there something else that I should speak into there, Tim?
No, no, not really. I mean, again, that's a very small. I find the mega caps to be very highly correlated. Big tech is a huge driver, but they're interchangeable in the basket. I mean, to me, they still, well, if you take a central tendency, they look very similar. And you'd say, well,
They're
why wouldn't
almost,
you put the
yeah.
daily, why wouldn't you put the daily data? And I can answer that question all the time. We could toggle it there, but statistically, and we have looked at that data for a very long time, there is no statistical advantage, and can be a statistical disadvantage to measuring data on a daily basis, as anyone knows. In the statistics function, and from a performance standpoint, they're highly correlated.
Mhm, mhm. In terms of thank you, Tim. I appreciate that. In terms of the what's ahead, I'll be watching big tech, and Tim already mentioned the jobs report. I've been talking to my investor relations clients today, and I kind of see it as a little bit of a holding pattern right now going into the jobs report. I don't know exactly why it's taking on such great importance, probably because of the Fed and potential rate cuts. But if this to me has kind of held the market up. We never went below neutral, and the market dipped a little bit. This uh, good market structure lesson, this came right after VIX expirations, is when we saw the downside. And if you look at this upside versus April, it was almost identical. We started to recover right after expirations. You hear us talk about it. You hear us talk about inflection points for right now. We're seeing it play out in a similar manner. So what happens to sentiment coming out of tomorrow's job reports? That's one item I'm watching. We're once again just tracking this extreme outlier right now. We're about 1 month, yeah, about 1 month with this, much higher short volume regime. Once again, if we look back at other outliers that we've seen in the data, when we look back at 2020, that was about a 3-month stretch. Could short volume stay elevated for a while longer? Absolutely. But at some point, you do see that those short volumes did get covered later in that year. So we do remain in an extreme outlier position. I am watching sentiment kind of first and foremost, and kind of take it from there. But that's where I'm at.
Yeah, I'm I'm still wary.
Hmm.
So
Hmm.
I'm still wary. I think that the risk of that shoe dropping remains, and it may never drop. It's like Jamie Dimon said about the bond market. This it really got attention. He said um, it's it's gonna break. Now I can't tell you if it's 6 months or 6 years. That the condition we've got is gonna break. I just don't know when. And could be long delay, could be tomorrow. I don't know. So we'll just take it accordingly. And if you're not exposed, you have to really be careful with. I always say, be careful with volatility trades because volatility can go away and and suddenly reappear and catch you out. But the long short trade, those are it's a pretty peaceful trade when you know conditions are just not giving you a reliable trend. And I would say there was not a reliable trend here. You can't look at momentum. Can you trade momentum? Can you trade low? There's a better chance in low volatility. But is that reliable? Do we know we're at a bottom? Well, we got important tradable news tomorrow. Broadcom reports after the close. By the way, you can always go check that. I can't tell you what's going to happen there. I could look at the demand supply equation and say, well, it's a lot like the market. The demand side looks fine. The supply side, if you ran calculations on that, even though it's fairly low relative to the market or the relative high point back here in April, but this, it's kind of an outlier where there was a lot of liquidity created and the market surged. It's a meme stock effect. And it went away, and all those market makers have removed that excess supply. See those two things sort of match each other. That's come out. This is new. So I don't know. You could run a model and say, well, their stock's going to decline, but I wouldn't bet on that given this. It's been a very strong stock. And now it's one that can be a tradable event. I think the reports after the close. And then jobs data tomorrow. If you told me we have jobs data and I looked at that, I would say, well, I'm sure not betting long, but I don't know. You just cannot predict from one day to the next, which is why I like the data. I continue to say we are going to have a volatility event, but I don't know when, and there is always the probability that I'm wrong. So we'll see. That's all I've got.